agenda today, or brief agenda. Oh,
Can we do the roll call for Sarah?
oh, that's right. Let's do the roll call.
Jerry Abrahams,
Here, present.
Commissioner Dom, Phil DeFranza, Tim Hodges, Catherine McKinnon,
Here.
Commissioner Perez,
Here.
Franklin Perry, Sarah Sanders.
Here.
We do have a quorum present.
Okay, well, good morning. We have a pretty brief agenda with reports and just the approval of the minutes. And the first item is a report from Bank of America on the 2003 Series A bond issue. Over to Hazi.
Thank you, Sarah. Good morning, everybody. Here with me in the office is Barbara Feldman and Joe Manito from Bank of America Securities. And they'll be providing to the committee a recap of the pricing that occurred earlier this month. I would say that it was very good for CHFA to enter into the market, and for me personally, because the last time I was in the city for the pricing was back in January of 2020, right before COVID.
Wow.
It's always good to go back on the saddle and do what we do best. So without trying to take away too much of the thunder from our esteemed guests here in the building, the sale went very well. So I will pass it over to Barbara to start it off.
Thank you, Hazim, and good morning, everyone. I'm the Barbara, part of the Joe and Barbara team from Bank of America. And on behalf of our firm, we would like to say thank you for having the opportunity to be the lead manager on what was the first single family deal, at least for 2023. The deal was priced on March the 7th, and like many issuers, many of your competitive and sister issuers, the challenge was to navigate the markets as they have been volatile and very responsive to the news of the day. And in fact, when we came into the market, we'd experienced about a 50 basis points rise in municipal rates over the last 30 days. So with that as a backdrop and curiosity about what the Fed is going to do next, and with what followed our deal, which was the sort of the banking crisis and what has been going on, it really has been a challenge to try to get through as easily as possible. But the deal was a success. It started out at about 168 million. The authority chose to up the deal slightly to 171. So we started marketing 171 million and change. And things went very well. And I'm going to turn it over to Joe to tell you the specifics.
Great, thank you. So at the time of the sale, as Barbara said, the Fed was very hawkish. CPI and PPI were going to come out the following week. And then the week after that, on the 21st, the Fed was going to have their Fed meeting. The expectation at the time we were going into the market was that there'd be a 50 basis point move by the Fed at that meeting in 2 weeks. Interestingly enough, by the end of the week that we were in the market, SVB had been taken over, and ultimately the Fed only subsequently moved 25 basis points. So, you know, as Barbara pointed to, there was a tremendous amount of volatility going on at the time. Your transaction was extremely well received. Of the 171 million, you had total retail orders of 155 million. You had institutional orders of 327 million. You had $483 million of real order flow on your transaction. And then there was also stock orders, which the syndicate supported the transaction. And so essentially you had 573 million, or almost over $500 million in orders for your bonds. It was a very strong book of business, and it allowed us to accelerate the transaction from what we anticipated going in to be a 2-day order period to a single day, which allows you to sort of cut your risk of not being out in the market all that long. The transaction was so well received that up and down the sort of the maturity spectrum, we were able to improve yields, lowering yields by as little as 2 and as much as 10 basis points up and down the curve. The book itself was well subscribed. And so, not only did you have a tremendous amount of order flow, but you had orders in all maturities, which doesn't always happen. Sometimes there is a sort of a soft spot, if you will. You didn't experience that. You had tremendous sort of participation throughout. You also priced the same day that another issuer was out in the market, and you probably outperformed them by about 5 basis points up and down the curve. And interestingly enough, when we went out, we had decided through several conversations along the way to market a longer, what we call PAC bond. We marketed a 6-year PAC bond. The other transaction that was marketed was a 5-year PAC bond. You were 2 basis points lower in yield, but you were actually a whole year longer. And what that allowed for was the PAC to be about 20% larger. And PAC bonds are, as we've talked about in the past, a very strong subsidy for transactions. So being able to do that was extremely helpful to your cost of funds. You achieved full spread, and you actually were overspread so that you created zeros, which allow for future subsidy to be put into the transaction to the extent that you hit a harder market in the future. The last thing I would say is that the deal was what we would call plain vanilla transaction. It was all fixed rate bonds. It had this one bond which had a special characteristic. But interestingly enough, the last time we did a deal, we included what we called a bank PAC bond, and we were able to save at that time 40 basis points on that. Roll around to this market, and the relationships had changed so much that had we tried to do that, we would have saved at best 5 basis points. So, I think that the point was that when you can do a very simple transaction, essentially what that allows for is for you to warehouse capacity for the future so that you can do variable rate when it makes sense. You can do a direct purchase when it makes sense. You essentially save capacity. And that's what we were able to do here in this transaction. And so although it doesn't look like it was as fancy, it was equally as effective because of what it allows for in the future, which is more flexibility. Couple of other sort of highlights, on the individual retail side. Well, let me say this. You instituted a policy where you paired us up with a minority firm, Ramirez. They did very well, and you actually changed the designation policy to make sure that they were fairly compensated, and they were compensated well in the transaction. They probably, next to us, probably made the most money in the group. And so essentially you created a target and an incentive, and lo and behold, it worked as planned, and you accomplished the goal that you wanted to accomplish. So, that was very good. Of the retail, of the 155 million retail, 114 million of that was what we call sort of two-legged retail or mom and pop retail. That's a tremendous amount. That's 74% of the retail orders being individuals, as opposed to what you normally see, which is a higher concentration of what are called SMAs, or separately managed accounts, where professional money manager is buying for the retail account. So, this is a tremendous sort of vote of confidence, if you will. People like your bonds in the state, and you get a tremendous reception in the state, much more so than others would. With that said, the only other thing I would kind of add is oftentimes we talk about how you guys punch above your weight and how well you do marketing bonds and how well you do running your business. And I've been speaking on a number of panels recently, and so I would pull together some information. And so I would share some of that information with you because I think it's sort of interesting. If you look at all the various states out there, obviously, California with 40 million people, New York with 20 million. If you look at sort of the top 10 issuers, from a population standpoint, you're 29th in population at about 3.6 million. You're 12th in issuance in the housing space. And so you're punching well above your weight. And if you were to sort of adjust for population, all the people ahead of you, nobody is quite as efficient on a per capita basis as you are in selling housing debt. And so, it's a tremendous sort of accomplishment that you're extremely efficient. You have a very strong penetration, And essentially, what you'll probably see in the future is that folks are going to start to emulate what you're doing because you're going to be volume cap constrained. Others are volume cap constrained. And so being able to do sort of the plain vanilla deal and saving capacity will allow you to do things like add taxable debt in the future or add variable rate debt in the future, all of which you're going to need because you will have, let's see, what is the number here? Your volume cap is for the state, 397 million as a number. You sold last year $725 million in bonds. And so the only way to have been able to do that is to add taxable, is to recycle prepayments, is to be very sort of astute with how you manage your program. And obviously you guys are. If you look at the other folks in sort of the top 10, nobody's really quite as efficient at using their volume cap and reusing their volume cap as you guys are. So with that said, that's the end of my presentation, and I'd welcome any questions.
I have one question. So you said that I guess we had 500 billion in I don't know if that's total orders or surplus orders, and then you did a 2 to 10 bump. After you did your bump, how many of our orders dropped off?
That I will have to get you. Essentially, the transaction was probably about 3 times oversubscribed. Typically, what we try and do is we try and raise the lower the yields and raise the price enough to actually scare away investors, because essentially that makes it easier for us to allocate the transaction. So I do know that there were some drops, but I don't have that number handy, but I can certainly get it for you.
Right. I mean, exactly. Because like, you don't really, like, I don't see being oversubscribed generally as such a good thing, right? Kind of implies bonds are cheap, right? So, which I understand you need to do that. I understand that investors are not going to buy an issue unless, as in a primary market, unless it's attractively priced. So you do want to have a healthy order book. And I understand that you know, the syndicate's not going to want to commit a lot of capital and take down bonds, which is perfectly rational. But still, it seems to me that you do want to, I'd like to know that we've hit that point of price tension where, people are like, huh, and that's, so it's
Yeah, so
you can follow up and get us that, that'd be really helpful.
I certainly will. The other thing I do have in front of me is a little bit of data. So for example, Iowa, which priced a $76 million deal right up against you, had spreads up and down the curve, which were to the index that we price against, which is called MMD, which were 5 basis points higher in yield. And so we're also balancing the fact that there are competing orders, and to the extent that we scare everyone away. When you're 3 times oversubscribed, there's sort of a difference when you look at any particular maturity, because sometimes what you have is you have 3 orders all for everything on a particular bond. And sometimes you have a tremendous amount of retail and orders institutionally for 5 million block or 10 million block. Those types of subscription are easier to get even more aggressive because it's not digital. If you lose 3 orders where you're 3 times oversubscribed, but they're all or none type of orders, you've lost the whole book there. Whereas in the other maturities, you have a lot more pressure that you can exert. The other thing I would point to is that a couple of weeks after New York State HFA came with the transaction, and interestingly enough, the index was much lower. New York State HFA prices quite well also because they're a high tax state. When you compared sort of like to like, you were on the term bonds 8 basis points lower in yield to the index. On the second term bond in 43, you were 16, and on the third term bond, you were 15 basis points through them. So I think that when you look at comparison and how you price relative to others, you price extremely well. And I will try and track down for you sort of what drops we got and what the final book looked like after we did the various repricings. The other point I would make is that we ran a retail order period and repriced after that. and we ran an institutional order period and repriced after that. So we also had a couple of bites at the apple.
Right, and your expectation would be the retails are stickier and the institutionals are a
Correct.
little more mobile. Hey, thank you for that. Hazim, I think I did ask this before. We track our spread to MMD, right? I have no idea how Iowa trades versus Connecticut. So I don't know, right? So, but do we track? And I know that the spread to MMD is going to, spreads to MMD will be, somewhat dependent on time. But do we track like our historical spread to MMD? So, and I know we're going to be rich to MMD typically. But do we have some type of consistent relative basis for estimating performance?
Yeah, we do. I mean, so long as it continues to remain relevant, right? Because part of the challenge about trying to say that there is in fact a fixed spread based on a particular duration is tough, just because that the dynamics and the relationship between MMD and treasuries, it changes over time. So that's part of the reason why that before we enter the market, we always require and request for price comps to see where everything is currently at, how it was priced previously. We work with our FAs to scrutinize and to make sure that that is in fact the current price. But generally speaking, that there is an expectation regarding what would be the typical spread over MMD for a 10-year paper, for example. So whenever that we see that, say there was a time when interest rate came down by a lot, then all of a sudden the spread over MMD went up because investors were saying, well, you're still getting an absolutely low rate, but from their standpoint, they basically said, we just can't continue to say the net rate that we were going to get will remain based on a particular fixed spread over MMD.
Yeah, I understand that. Okay. And I assume that you've got a pretty good intuitive sense that okay.
Yeah.
Depending on market conditions and where you are. Okay. Thank you.
Well, one last point on that, and I can certainly help you because I do have I track all your deals, so I can give you that data, and I will. You'll notice, to Hazim's point, that there can be changes in the market characteristics. So, for example, a year and a half ago, spreads for PAC bonds were 60 basis points, and now they're 140 basis points, which is unbelievable as far as the difference. And a lot of that has to do with the fact that folks are concerned about extension or acceleration because of the volatility in prepayments. So we'll provide that, but to Hazim's point, there's always a backstory when you see a gap like that, and we'd be more than happy, to the extent that you have questions on it, to help provide some of those answers.
Commissioner, you have your hand up.
Commissioner Perez, do you have a question?
Yes, I do. I was waiting for people to finish. I don't want to take away from anything that Jerry mentioned, but I mean, I think that the market conditions in some ways might have helped us, because housing, there is a group of people that love to invest in housing, right? And in particular, in low-income housing, because for whatever reason, right? I mean, they're not going to invest on it if the return is not reasonable. But there is a group out there that will do that. And then also, I just came from a 2.5 days powwow with all the commissions from the East Coast and the Federal Reserve, all 3 Federal Reserves from the East Coast, and OCC, CFPB, FDIC. And I can tell you that one of the big concerns that we have, besides liquidity for banks, is that unrealized losses. And not every security gets treated the same. And bonds like this one get treated much different than a bond that is not secured by real estate, because it doesn't lose the value the same way. Now, having said that, I was curious, and I know nobody has a crystal ball. With all those unknowns that were happening and how the market was behaving, did it make sense for us to maybe not do it that week and do it a different week? Do we know what happened a week later, what the rates was, the average? And I'm not second guessing anybody, I'm just curious.
Yeah, so for example, the following week,
Or 2 weeks after the market kind of settled, even though it hasn't settled per se yet.
yeah, so a couple of things between, gotta find my paper, but I actually have that somewhere. So between the week we came and yesterday, as an example, because of all of the changes that have occurred with regard to, SVB and other banks, Credit Suisse and what have you, the front end, of the interest rate curve and the scale that we price against has gone lower in yield by about 46 basis points. And the back end has improved by about 23 basis points. And so as a result of all of the sort of machinations, we've seen a general improvement in the index. We've also seen, to Hazim's point, the spreads widening over the course of time, but we're probably, had we priced this week, we would have had lower rates.
Yeah, I mean, so as for my education, again, I'm not second guessing anybody because nobody knew that this was going to happen this way. Some people that were from the inside might have felt that it could, but even the insiders didn't know ultimately how the Feds, Powell in particular, were going to behave, right? Because some of us were even predicting he was not going to raise rate, and we definitely are predicting at this point from the inside game that if there's any other increase, it will be a quarter point. And there will be a couple meetings that there will be no increases, but that's just predictions, right? That's just people talking that think they know what's in his head, right? So my question is, I'm sorry.
I was going to say, I spoke at a conference and I had to keep updating the dot plot sort of chart that I sent because every day it changed so much as to be completely out of date.
Right.
As far as what the Fed expectation was, so.
Right, but I could assure you that the people, we were meeting with the three presidents, the Boston, the New York, and the Philly Fed. I'll leave it at that. But my next question is, do we have the option to pull the plug if we feel that the way the market is? And I think the answer is yes, but I just want to.
Yeah. So generally.
And again, I'm not questioning that you guys made the right, that we,
Right,
because ultimately you follow our direction, right? That
Yeah.
we, through him,
Yeah,
make the right decision or not. Since we have a little time, and I am an accountant and I'm a banker, but I'm not a securities person, even though I regulate securities.
So let me just provide a very high level. So the way that we operate, the first thing what we do internally is to determine when do we need the liquidity to replenish our funds to provide the proceeds for the program. So once we have a number, a rough idea in terms of how much we would need based on the particular period and then the time frame, we would then work with our FA and the lead manager to determine when we believe will be the right moment to enter the market. So during that finding, we will also work with the Treasurer's office to make sure that the state is not selling the bonds the same time as us. There's no major economic news. The Fed is not meeting. So we try to avoid the week when we think that there will be a lot of speculation in the marketplace that will, create more noise than it should be. So, based on what has transpired since the Fed wanting to tame inflation, we don't think that's actually a right week per se, because every week seems to be different than the prior week. And we have seen the market move not by a few basis points, but by 10 to even 50 basis points, depending to how bad or how good the news may be. So that's the plan. But if in any event that if we approach it a week, or if we think that there's a lot of sensitivity or there's market disruption, then yes, we would pull the plug or we would delay the deal. And we can do that at any time.
Thank you for the clarification. But I mean, my last statement would be that in my opinion, this kind of bonds will be very attractive in the next, few months at minimum. Only because I could tell you not every security is treated the same, right? Because real estate is still the king, especially housing real estate, and especially if you're not doing 100%, the portfolios that I made up of 100% financing. I could tell you that there was an American Banker article that came out, I think it was Monday, that was not as bad as it originally would have been, but it was right on the money that probably 90% of every, what they call community banks, right? Community banks at 10 billion and less, if they had to realize the unrealized loss, they will all have negative capital. Every single one of them. Now,
I'm
Now,
sorry.
the truth is that they're not going to be required to realize that unrealized loss right now. But that's one of the things that happened with Silicon Valley, right? They had a crunch for liquidity, so they had to sell bonds that had lost value, and that pot that they sold had an unrealized gain of $1.8 billion, and they had to take that hit.
Loss.
Loss, right? They had to take that hit as a loss,
HCM,
right? Because it was an unrealized, I should say, I did say gain, but I meant to say unrealized loss of 1.8 billion, and that's part of what brought them down.
Right. Just as a side, I priced 2 deals this week, and the market dynamic is different. There wasn't as much volume in the muni space as there had been the week you priced. And the commentary heard during the pricing is, well, we're afraid that somebody's going to come out of the woodwork and start selling their muni portfolio, just as for the reasons you're suggesting. And that could impact pricing, so-called maybe distress sales or whatever would affect things. So our market is not as huge as the treasury market, and we're very sensitive to these little gyrations in volume, rates, appetite, ratios. So we do gyrate quite a bit.
Yeah. So, I mean, that was the only way for me to say that. Good job. I mean, I'm not second guessing it. I mean, nobody had a crystal ball. But if we have some more bonds that we could sell in the very near future, we should consider it, because I think we get very attractive rates. Because I think there's going to be a bigger market for them.
Well, we have
That's
other,
my opinion. There's not like the Federal Reserve would say. This is not the opinion of the Department of Banking. This is the opinion of me personally. The Federal Reserve, even though they prepared the slides and the presentation, they always say it's not the Federal Reserve's opinion; it's the particular individual employee. All right, I'm all done. Thank you.
Any other questions? Nandine, Hazim, I hope you don't mind. I just want to take a minute to talk about something that I think is relevant and of interest to this committee, given what we're talking about. And so I want everyone to know that Governor Lamont and State Treasurer Eric Russell are co-hosting the first ever Connecticut Investor Conference on May 23rd at the Connecticut Convention Center. It's very exciting. We have never done this before. Massachusetts has been doing it for years. It's going to feature some panels of interest. One's on affordable housing, one's on climate change, one's on transportation, one's on the fiscal guardrails for the state of Connecticut. And our housing panel features Executive Director Nandini, Commissioner of Housing Sheila Mosquera Bruno, and DEC Commissioner Alexandra Dom. Thank you, ladies. And in addition, our moderator is Barbara Feldman from Bank of America. So I just felt I needed to tell you all about that. And another exciting aspect of it, we got excellent discounts because we're a state facility, state event going on at the Connecticut facility. But we also have our sponsors, our CHFA, Connecticut Airport Authority, the Connecticut Green Bank, and the Metropolitan District Commission, so that they can be reaching out to their investors. And our attendees are targeted to be our large investors that invest in Connecticut paper of many issuers. Also, the other members of the financial group that help us bring our bond sales, such as investment bankers, financial advisors, some bond counsel, and rating agencies. So It's very exciting. We hope the registration to be live by the end of the week, and I just wanted everyone to be aware. And want to thank all the members that have agreed to participate.
So board
Okay.
members get free registration, Sarah?
Well, the event is free, but registration is required because we may close out, but we wanted our first event to be free. But what was your, yeah, and I would, I defer to Nadine, but I would certainly invite board members to attend. And,
Sure, absolutely.
yep,
Total sense.
especially since CHFA is a sponsor, so
We encourage committee members and board members to attend.
great, yes. And we have a lot of, the wonderful thing about the convention center, it can expand up and down any size you need. It's really flexible. So anyway, that's exciting for us, and I'm looking forward to the panel, and thank you, Barbara, for being our moderator. And with that, we'll go on to our reports. Allison Murphy, financial report.
Good morning. Before you are the February financial reports. On the revenue side, mortgage loan and investment interest revenue are coming in slightly above budget for the month and 8.1 million higher than last year. The year-over-year variances continue to be driven by the increase in the authority's short-term interest rates. So to give you an indication, the stiff rate as of February 28th last year was less than 0.25% at 0.16%. And that same rate this year as of February 28th was actually 4.67%. On the expense side, bond interest expense is slightly below budget for the month and 8.4 million higher than prior year. There are several things that are driving that year-over-year variance. Our outstanding bonds are actually 110 million higher than the same time last year. Interest rates in the authority's variable rate bonds have increased. And lastly, the authority had 4.3 million in bond premium amortization this same time last year that we do not see this year since we have not had any redemptions. Administrative expenses are coming in 1.8 million under budget and 15,000 higher than last year. When you exclude salaries and benefits, or 4.6 million, the current year expenses are 286,000 lower than last year. Bond issuance costs are 1.1 million below budget. And as you've just heard in detail, we just closed our first bond sale of the year in March. So we expect to recognize the majority of those costs during the month of March. And lastly, the change in net position is above target by $2.6 million. Are there any questions?
There's no questions. We'll go on to the next report. Delinquency, John Chilson.
Good morning. For the month of February, the authority purchased 434 loans, single-family loans totaling $95.5 million, of which 400 loans were securitized at $86.3 million, or 92% of the monthly production. The remaining 34 loans were whole loans totaling $9.2 million. The average loan size was $220,000. The February month-end mortgage-backed security balance was $2.3 billion. It was an increase of $75 million over the prior month. Well, the whole loan portfolio, as at the end of January, declined by 28 loans, but the dollar value of the portfolio increased by $31,000, ending at a balance of $1.1 billion. The overall delinquency rate between the two portfolios was 2.04%, which was 23 basis points lower than the prior month. And the carrying balance for loans in foreclosure year over year decreased by $8.4 million to $20 million, while the number of loans in foreclosure decreased by 51. And for the month of February, the authority also funded 231 down payment assistance loans, totaling $3.4 million. The average loan size being $14,860, resulting in 53% of the February borrowers took advantage of the down payment assistance program. The authority also funded 103. The authority also funded 131 time to own forgivable loans, totaling $4.1 million. The average loan size $171,000. For a multifamily, there were no new loan closings in February. The total loans remained unchanged at 561, totaling $1.3 billion. There also was no change in our delinquencies. There were 6 permanent loan delinquencies and 1 construction loan delinquency, with the overall delinquency rate of 1.2%. Any questions?
Ooh, Miwa.
Any questions? With that, we'll move on to our final item, which is the approval of the minutes of the Finance and Audit Committee, February 23rd, 2023. May I have a motion?
Make a
Moved.
motion.
Second,
Second.
roll call vote.
Jerry Abrahams,
Aye.
Commissioner Dawn, Phil DeFranco,
Yes.
Timothy Hodges, Catherine McKinnon,
Aye.
Commissioner Perez,
Yes.
Franklin Perry,
Yes.
Sarah Sanders.
Yes.
The vote passes unanimously.
Okay, are there any other questions or comments before we adjourn?
Sarah, can I make an announcement?
Yes.
Tomorrow, the president of the Federal Reserve of New York is going to be in town. I mean, not in Hartford. I mean, he's going to be in 3 towns in Connecticut: Stamford, Norwalk, and Bridgeport. And Stamford is going to be having a panel with elected officials, Norwalk with businesses, and in Bridgeport with local nonprofits and other people. Stanford's going to be focused on economic development from cities and so on. Hartford, I mean, Norwalk will be on small businesses and their needs. And then on Bridgeport, it can be more around workforce and climate. So if you haven't heard about it, he's going to be in town. Those who really like that kind of stuff, you could, it's public. There was a press release on it. People could attend, And in fact, I'm going to be in the panel in the one in Bridgeport.
No.
They wanted me to be in the panel in the Norwalk. I said, no, I don't go beyond New Haven. But I realized that he's in New York, it's not Boston. So therefore, I chose Bridgeport. But that's an FYI.
Thank you for letting us know.
Yeah.
Any other comments, questions? Okay, so we'll plan to adjourn. All in favor?
Aye.
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 Okay, thank you.
Thank you.
Thank you.